Hello and welcome to Nirmal, ladies and gentlemen. I'm Hira Dadia. We have with us Dr. Rupa Rege, Chief Economist at L&T Finance Holdings, joining in. Welcome to the show, Dr. Rege, and a pleasure to speak to you as always. Dr. Rege, my first question coming to you is, all of us are talking about what's happening across. There is a lot of liquidity that's being pulled out by central banks across the world. And simultaneously, you're seeing a scare of the third wave, which is creeping in as well. A lot of global markets have already seen the scare. India is now picking up that fear of the third wave as well. What's your assessment of the situation?
I feel it's too early to panic. If you look at the response of global central banks, I mean major central banks globally, that is also quite mixed. While Bank of England is one of those 7 major banks which has actually taken a baby step of increasing rates, US Fed has signaled that there will be a faster pace of tapering and a few rate hikes next year. But then ECB has concluded that inflationary pressures are transitory and they would like to adopt wait and watch policy. Similarly, Bank of Japan, I mean, though they have indicated faster pace of tapering, they have held their rates at rock bottom levels. China is into giving stimulus. So I feel that saying that everybody is on the same page is also not correct. There is a lot of uncertainty. Omicron, we have seen that there is a lot of panic currently in Europe, and Netherlands has gone for a lockdown, and other European countries are following the suit. But then, the reports from South Africa and the actual experience of Omicron infected people in India shows us that it's less scary in terms of mortality rate, and symptoms are relatively milder. And this is how the viruses have always evolved in the past also, that, at the higher levels of evolution, their symptoms become milder and recovery rate improves. So I think it's too early to press the panic button.
Right. So with all of this, what's the view that you have in terms of growth as well as inflation? Because again, inflation is a key concern across. If you talk about, in terms of India as well, the CPI inflation, at least in terms of where the month of November goes, we came in at around 4.91%. And the Bloomberg consensus estimates were around 5.1. And the core inflation has stood at 6.1% in November 21. Overall, what do you think of this number? Because yes, there has been a temporary relief from RBI basis, the November CPI number, but the core CPI is sticky at 6.1%.
Yeah, very true. Actually, my inflation forecast was spot on. I had forecasted it to be 4.9. And it was entirely on the back of, the kind of food inflation we have seen in November because of excess rains and distortion of transportation, etc., logistics issues for food inflation. And for core inflation, it is entirely administered price inflation, because higher prices of telecom and other, the pressures are more from cost side rather than from demand side. And that's why if you read the RBI MPC minutes carefully, a lot of MPC members are saying that they are waiting for more strong evidence on demand pull pressures. So it's like, the narrative is more in the direction of stagflation. Everybody knows that growth, the economic recovery is not very robust, not just in India, across the globe. I mean, except with the exception of US. But if you take the case of UK or Euro area or Japan, China, everywhere growth concerns are quite serious. Similarly, in India also, we are seeing a lot of divergence in growth rates and unevenness in sectoral growth rates. There is a clear-cut divide between organized and unorganized sector, large and small companies, urban and rural areas. And I think Reserve Bank of India is quite aware of that. So, they also know that any premature tightening can really hurt growth more than control inflation, which is entirely originating from supply side. So I think Reserve Bank of India will adopt a more calibrated approach going forward. They will see to it that there will not be any shocks so far as the liquidity tapering is concerned or rate hikes are concerned. And, I think they are trying to be quietly effective, which I think is the need of the hour.
Right. And in terms of the IIP as well, it seems that the growth is flattening out, but it is above those pre-pandemic levels. So what do you make of that number as well?
That is just slightly above the pre-pandemic level, but I will give more credence to second quarter GDP numbers. If you compare the first half of FY22 with the first half of FY20, which was the pre-pandemic year, then we are still below, the pre-pandemic level. And that is acknowledged by all economists and experts in the Reserve Bank of India also. So we cannot say conclusively that we have reached the pre-pandemic levels yet. Similarly, if you look at IIP, clearly we are seeing that negative growth momentum has continued for consumption goods. And that shows, continued weakness in demand. And here I'm seeing more weakness coming from rural demand side rather than urban demand side. And that's because, you see, we have been saying that, this time rainfall was normal and sowing both Kharif and Rabi on track. And that's why we expect rural demand to be resilient. That is not the correct assessment, because this year we have seen so many extreme rainfall events. If you even, temporally, rainfall distribution was very uneven. We had few months of excess rains and few months of deficient rains. In just the month of October and November, there were more than 130 extreme rainfall events. So that has impacted the crop yield, And if you look at the leading indicators of rural cash flows, you see the mandi prices of major Kharif crops, they are still ruling below minimum support prices. Because of, whatever, the lack of funds, job creation under Manrega has not been as good as it was last year or year before last. So, and that is getting reflected in the recent data points for rural economy. Look at the tractor sales growth or motorcycle sales growth or consumer non-durables growth rates, which typically form the basket of rural consumption or rural purchasing power. Everywhere we are seeing negative growth momentum. Even large FMCG companies like Hindustan Lever, Dabur, Marico, they have signaled some kind of caution on slowdown in rural demand. So I think it, yeah. So
is that going to be a major concern that we need to solve for?
I think that is being discussed with the government of India in pre-budget consultative meetings. And I'm sure they will increase the funding support to Manrega to create more of non-farm rural jobs. I think people are aware of it in policy circles and they are attaching enough importance to that.
Right. And overall, if you see in terms of the RBI as well, the way they're looking at the policy as well is, one, they're looking at a gradualism and policy normalization. And two, do you think the motto is to then ensure soft landing over there? Because clearly accommodative stance is something that they have continued with. So what would your view be in terms of by when the RBI would start increasing rates?
See, I'll tell you one thing. People are making a distinction between liquidity normalization and interest rate normalization. But actually, what matters for interest rates is availability of liquidity in the system. And RBI's calibrated efforts to suck excess liquidity already has impacted interest rates in the market and cost of borrowing at the shorter end of the yield curve. If you look at the movement of interest rates across different tenors, then short-term interest rates have gone up by 50 to 60 bips between October policy and September policy. So actually, RBI's actions have been effective in raising interest rates. But at this stage, if they give a signal of reverse repo rate hike or repo rate hike, then that there will be overreaction in the fixed income markets that they want to avoid. So I think they will focus more on liquidity normalization than interest rate normalization. And now, though, everywhere in the world, we have again started seeing growth tapering because of Omicron spread and imposition of lockdowns, etc. Yesterday, oil prices also crashed. Commodity prices also have started responding to this scare. So I think I feel there will be a postponement of interest rate hikes rather than preponement.
Right. And overall, from there on, what's your outlook in terms of where the fiscal deficit goes, the government expenditure and the private expenditure is concerned? How are you looking that should be balanced out?
See, I think central government has done pretty well in managing its finances. And at least, their mobilization through GST has improved considerably. And their revenue spending, they have curtailed, unproductive revenue spending, they have curtailed quite effectively. So those have been the positive points of our fiscal management. But then I feel that, they very well know that Reserve Bank of India's actions cannot support growth beyond a point. And there has to be a direct stimulus, especially to rural sectors and many weak sectors like MSMEs, etc. And their disinvestment receipts have not been on track. So there is a concern that they may miss fiscal deficit target by margin. And we should not attach too much importance to that, because we are not the only country where this will happen. These are exceptional times. We are all struggling with a pandemic, which is one of its kind in last 100 years. So, the focus of monetary and fiscal policy has to undergo a change. And we cannot hastily go back to a rule-based framework which was implemented during normal times. We have to acknowledge that these are not normal times. There has been a huge loss of lives and livelihoods, especially in the informal economy. And nobody but only government can support informal economy, because private sector has its own limits.
Right. And what would your estimates be for inflation and growth if you have to look at FY22?
Well, this year for the FY22, I feel overall inflation, I agree with Reserve Bank of India, because that was my forecast also. It will be around 5.3%. Next year, it may go further depending upon how Omicron spreads within India and how it, impacts supply side versus demand side, etc. But yes, cost push inflation is a new worry, and that may keep core inflation elevated. So inflation will be closer to the upper bound of the tolerance range of Reserve Bank of India, rather than to the closer to the midpoint, which we are seeing throughout FY22.
Right. And any other aspects, Dr. Rege, that we need to consider to see if there are any red flags going ahead?
Yeah, definitely, because I feel this unevenness in growth is a major downside risk for India. And now, the big event from the perspective of domestic policies is union budget. So in that, we would like to see what kind of support government gives to all vulnerable sectors. especially rural economy, because even though agriculture's contribution to overall GDP in terms of value added is just 14-15%, rural economy takes care of more than 50% of aggregate monetary demand. So we cannot, government can't afford to ignore that sector. So, and I think so far as inflation is concerned, they have already started taking a lot of measures. They are banning futures of many commodities. They have reduced import duties on edible oils, etc. So those measures they have started implementing. But beyond a point, they also can't help much, because supply side disruptions created by this pandemic are so massive. World over, there are shortages of basic raw materials, inputs. Like we know how semiconductor shortage has impacted the whole automobile industry world over. Similarly, fertilizer shortage. It is impacting agriculture not just in India but in other parts of the globe also. So we have to now learn to live with shortages. We have to learn to live with high inflation and low growth. So again, we are back to 1970s, 80s kind of stagflationary concerns.
Absolutely. And I think these are problems we need to solve for as well. Thank you, Dr. Rege, so much for joining us on the show. As always, a pleasure to speak to you and get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you, and same to you. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.